Okay, well, hello and welcome everyone to the Legal Issues Committee webinar, our first quarter webinar today. My name is Jarlath Curran. I am the chair of the Legal Issues Committee this year. Before we get into the topic and our speakers, I first wanted to give a thank you to CDF Labor Law, who is our sponsor this year. We have Ashley from CDF with us, so I'm going to turn over to Ashley to say a few words.
Thank you, Jarlath. CDF Labor Law LLP is a proud and active member of the CMBA. For those who aren't familiar with CDF, we are a California-focused labor and employment defense law firm with 5 offices throughout the state, starting up in Sacramento and down to San Diego. We have a natural synergy with the CMBA as we focus solely on California employment law, and a significant portion of the legal services that we provide is to the banking and mortgage industry. To highlight a few of the services that we provide, we defend companies with workforces in California against claims of sexual harassment, discrimination, wrongful termination, and wage and hour violations. We also provide day-to-day consulting services and advice and counseling for compliance strategies so our clients can avoid litigation before it becomes an issue. So please reach out with any employment-related questions or issues. Thank you. Back to Jarlath.
Thank you, Ashley. Thanks again for CDF's sponsorship of the committee this year. It's very, very much appreciated. So moving on to the webinar discussion today, the presentation is about fair lending issues. We have 2 fantastic speakers that I will introduce in just one second. First, I wanted to make a note that once the presentation is concluded, we will hopefully have some time for some Q&A. To give us your questions, just type them into the chat option on your computer. We will keep an eye on that as the presentation goes on, and then once John and Jeff are done with the presentation, we'll go ahead and read those questions to them so they can answer your questions. But without further delay, let me introduce our esteemed speakers today. We have Jeff Naiman and John Coleman, who are partners at Orrick, Harrington, and Sutcliffe. They're both located in Orrick's Washington, D.C. office. Both were partners at Buckley, which merged with Orrick last month. Jeff was one of the founding partners of Buckley and has been advising mortgage lenders and servicers in regulatory enforcement and transactional matters for a long time. John, prior to joining Buckley, was the Deputy General Counsel for Litigation and Congressional Oversight at the CFPB. He currently assists mortgage companies and other financial services entities with regulatory enforcement matters involving the CFPB, FTC, and other federal and state agencies. So both these gentlemen will discuss some fair lending issues with us today. So gentlemen, please.
Thanks, Jarlath. So we're going to talk a little bit about redlining, which has been the kind of focus of a lot of the fair lending issues that have come up in the last couple of years. And there was even a new settlement, I guess, a couple of weeks ago with a mid-sized bank in Columbus, Ohio. But there's also cases being brought against IMBs. So it's been a very busy time. We'll also talk a little bit about some of the other things going on with the CFPB. And hopefully we'll have time also to talk about, I know with California, you guys may have heard that Silicon Valley Bank failed last week, and that's generated an enormous amount of additional legal uncertainty into the banking and finance world. Signature Bank, which actually has a much bigger, I think, profile in the mortgage banking business. It has a lot of custodial accounts and so forth. And I think even some warehouse lines there, also was closed by the regulators and in essence reopened in a new shell. So with no further ado, we'll flip to the next slide. And we'll talk about how to protect against a redlining claim. And this isn't really like so much of a focus on how to protect in litigation, so much as how do you prevent from having to have one of these, although the 2 things are closely interrelated. So I'll flip the slide. So Where are the regulators and enforcement officials coming from? This is a quote from a very famous progressive academic named Ibram Kendi. He speaks to great acclaim at all the universities and so forth. And he wrote a book, How to Be an Anti-Racist. But the money quote is, when I see disparities, I see racism. And that's kind of essentially where the regulators start out. But disparities, if disparities were racism every single day, all of you would be violating the law because there are disparities in the underlying populations that our companies serve. So, but that's just like, they don't start off with, we think everything's fair, and we're going to try to prove that in this particular instance, something was unfair. They're going to say, when I see disparities, I see racism. Next slide.
Hey, Jeff, can I just weigh in on the Ibram Kendi slide? Just to put this into concrete terms with respect to this administration in particular, you know, they came in, President Biden came in off the mark and issued an executive order, you know, directing all federal agencies to try to root out, you know, historical impacts of racism in the wake of George Floyd. And the Justice Department announced in the fall of 2021 a combating redlining initiative, you know, hand in hand with the CFPB and some other regulators. And, you know, when this sort of thing happens, I'll tell you from experience, you know, the staff are basically charged with going out and finding cases. And, you know, I don't think that the political people in charge of these agencies are all that interested in finding out that, you know, they created an initiative to address a problem that doesn't really exist. They were certain that the problem existed, and so now they just need the cases to make good on their pledge. So there's that dynamic going on, as well as I think some, you know, sincerely held beliefs that there are, you know, either implicit or explicit biases in the mortgage market.
Yeah, that's absolutely right. So I'll just won't spend much time on it, but very quickly, when we hear the word redlining all the time, what is redlining? I would say there's like this first type of redlining, traditional redlining, which is where a lender would actually draw a line on a map and say, yeah, I want to lend in this area. I don't want to lend in that area. I won't lend east of this street. I won't lend south of this railroad. I won't lend, you know, whatever's considered the wrong part of town, in essence. And that's where kind of the whole redlining, and it was, these lines are normally drawn with a red line. So it was like, that's how where the word kind of comes from. So but that's not the cases that we actually ever see any longer. We don't see those cases. There are some cases like that in the early to mid 1990s, but you know, everyone kind of picked up on, you can't do that anymore. So that's not the kind of cases we see anymore. So now when you hear someone talking about having brought a redlining case, even though the language in the complaint will say, you know, intentionally structured their operations to, and it'll create a lot of word choices that make it look like it was all intentional discrimination. It's really about having a lower market share in majority minority neighborhoods. And sometimes it's majority minority. When I say majority minority neighborhoods, it may be majority Black neighborhoods, it may be majority Hispanic neighborhoods. And in some cases, they do a combination of majority Black or Hispanic neighborhoods. So it can include, if you had a neighborhood that was 30% Black, 30% Hispanic, and 40% white, they would consider that a majority minority neighborhood because the protected minority groups collectively were 60% of a neighborhood. The government also will play with what is, you know, is it majority minority, or does it have to be a super majority, like an 80% or 75% majority? So they'll play with some of the percentages. if that helps them to make a case. The way they make this case is they'll, do this kind of, it's a form of intentional discrimination where they combine comparative statistics where they say, look, your market share in, Los Angeles, the Los Angeles MSA is only 5%, but your market share in majority Black neighborhoods in LA is only 1%. And that's such a big gap between your market share generally and your market share in Black neighborhoods is so big as that we think we're going to infer discrimination from that. And then they kind of dig deeper. They look for other anecdotes about you that can allow them to bring this kind of case and kind of corroborate the statistical conclusion with some additional facts. And it's important to know that it's not about whether, so if you're making loans in Los Angeles and you make a lot of loans to the, to Black residents of Brentwood who are buying $3 million homes, they don't care that you're happy to make the loans on the basis, without respect to race in a rich neighborhood. They're talking about, this is a form of, in essence, geographic discrimination rather than individual discrimination. And finally, we also hear a lot in this business about digital redlining, which in essence is, are your algorithms that you use, including, FICO, right? Are they resulting in marketing or in originations that disproportionately exclude either neighborhoods or minority individuals? So that's another kind of piece of this puzzle. But the redlining term apparently has a lot of power. And so it's a term that government and the advocates want to continue using even when, kind of like they want to bring that into the electronic age in essence, because the redlining term seems to be a good, get good headlines. John?
Yeah, I just, to buttress something you said, Jeff, I mean, at a very practical level, the way these cases are developed is in the first instance, economists who work at these government agencies sifting through HMDA data. And so they run their, econometric models against the HMDA data that they receive from every mortgage lender. And that's who they identify to, start digging deeper on. And so, at the risk of stating the obvious, our advice is always that you all should be doing that as well for yourselves, replicating what the government is looking at. And if you do have a problem, or if there's something that you think the government is likely to pique their interest, it should pique your interest as well.
So let's flip the slide. So a couple more thoughts on the statistics. First, they look at it market by market by market. So if you're successful in Los Angeles, that doesn't save you from not being successful in San Francisco or San Diego or Stockton or any other kind of cognizable area. And that's something is we have a lot of clients that basically feel like we do everything the same way everywhere we do it in the country. But then, the government has identified, you have a problem in Milwaukee, or you have a problem in Columbus, or you have a problem in, Boston, or wherever it is. And they're going to say, and you say, well, look, I have the same policies. Everything I do the same everywhere. And they'll say, yeah, but why are you redlining in Boston? So that's kind of it'll be based on how do you do in each market? So you have to analyze each market kind of separately. I'm not sure if anyone on the phone is actually part of a depository institution, but depositories are subject to the Community Reinvestment Act. They have, officially defined assessment areas that are, defined under CRA. The government also created in that context something they call a REMA, which is the reasonably expected market area. of where they think you ought to be lending, even if it's not in your assessment area. This happens especially for banks located in a suburban area where lots of people, they're located downtown and everyone lives in a particular suburb. So there's lots of loans that are made in other parts of an MSA that may not be, or of an area that may not be in their official assessment area. And they're going to say, hey, we got to look at that too, not just in your assessment area. John, go ahead.
No, go ahead. I'll add on at the end of the slide.
I was just going to say, the next kind of issue is how low are your numbers? Do you have to be like, does everyone have to be above average? Or is it anytime you're below average that you're at risk? And I think there's not a hard and fast rule here. What the government likes to bring in a case, they like to bring a case where they feel they can say you're statistically, you are so much lower that it's statistically significant that your lower performance or lower penetration in the minority neighborhoods is statistically significant. That's not always going to be the case. And then you also have people where there's not a lot of lending in minority neighborhoods, and you just have no loans or one loan or whatever. And even though it may not be statistically significantly different, it's so little that they're going to pick on you anyway. So that's what we've seen in the market. And then we're going to start talking in a bit about, well, when they compare you, who do they compare you to? Is it compared to the whole market, or is it compared to some other subgroups? And we'll talk a little bit about how you push back on statistics. John?
Yeah, no, the point I was going to make about, following up on the assessment area versus the REMA is something that has become sort of a fixture of all recent redlining complaints, whether they're government or private litigation, is the sort of map in the appendix that shows the metropolitan area and has dots showing branches and then dots showing numbers of loans around it. And the government regards that as a very effective sort of pleading tool to demonstrate what they view as lending patterns that don't look reasonable based on the market area you presumably serve. And they'll line it up with census tract and indicate majority minority versus majority census tract. So that's another way of looking at this thing that I think is helpful and powerful for the government.
So can we flip to the next slide? So having found that you're significantly below the standard, how do you go about trying to convince the government that you're innocent? So this is actually where a lot of our time ends up being spent in these matters, whether it's in compliance and no one's brought it up at all yet, or if it's in an exam, or if it's in an enforcement action. Regardless of the context, we spend a lot of time on the next little bit. So can we flip the next slide? Thanks. So the first thing we do is we try to refute the government's statistical analysis. And it could be, we just need to have, better controls on, in the statistics. Were they really looking at like things? And you try to pick a peer group that's the right peer group. Is it banks versus non-banks? Is it people who make a lot of, hey, we're just an FHA lender, or we don't do FHA loans at all, and we shouldn't be compared with people who do make FHA loans. So there's product mix kinds of issues, marketing channel kinds of issues, like is it retail? Are you broker? Are you getting stuff off the internet? what is your mechanism for finding customers? And some of it's actually a lot of times market history, where the realtors who work in the neighborhoods where you are shy of loans may be just like, yeah, we don't really know you yet. When you've been here 10 years, then we'll know you. And you haven't been there 10 years. You've only been there 2 years. And so they aren't sending you loans yet. So your kind of market history in an area is actually very critical. It's also critical in the context of when you go into new areas where you haven't been in a particular city or town. You get an opportunity to start serving that area because a good loan officer becomes available, a whole branch of people become available, et cetera. And they will, as a rule, not have a perfectly distributed group of loans that they make. And so that kind of market history issue is a critical issue.
Just one thing on the marketing channel, it may well be a perfectly valid explanation to explain why your originations are spread across a geographic area, so that this is how we market it. But the government's response to that seems to be now, well, that needs to change. And if it's the case that you're in a joint venture with some real estate company who only services the suburbs, then you need to have an alternative marketing channel to better serve other parts of the MSA. And so even if the truth is, look, without any intent to discriminate, this is the way we market our loans, I think the government's attitude is going to be look for more opportunities, look for other alternative ways to market where you can reach parts of the market that you aren't reaching through this one channel.
Yeah, and two of the recent cases that involved IMBs has in essence that kind of issue in it. In the Trident case, it involved a lender that mostly marketed to the real estate customers of its affiliate, of its affiliated real estate company, which was mostly doing business in high-end and wealthier areas. And in part as a result, in the Philadelphia metropolitan area, that meant that it was kind of underrepresented in terms of real estate transactions in heavily minority areas. So that was kind of one. And then the other one was actually also very interesting in Townstone, which was a case brought by the CFPB. Townstone's principal form of marketing was that the owner of Townstone just got on the radio on, he had like a radio infomercial for, I don't know if it was a half hour or hour every week. And it was on a radio station that was, among other things, principally kind of a, conservative talk radio station. Not super surprisingly, most of the listenership to the conservative talk radio station that heard this marketing was a mostly white population. And the government came after Townstone for having, among other things, insufficient loans. And it kind of raised the question, do you have to, does your advertising have to be, doled out in this, kind of in a equal way across all demographics? But those are two of the cases that are right on point. There's other cases out there that are, kind of raise everyone's business model is a little different, but they raise in essence the exact same legal issue. Can we flip slide? So what else can you do? So, we've tried to fix the peer set and all that kind of stuff to, be it compared to likes and like things. Well, one of the things we hear a lot in the cases is, why don't you have more Spanish speaking loan officers? That's really one of the most frequent concerns we hear from the government. And it's, normally the answer that we have is, Well, we tried to hire them and they didn't come, right? And so what we ordinarily recommend is you have to make special effort. This is, you can't just rely on serendipity necessarily to get you a group of loan officers that's going to be able to communicate in other languages. The language that we're mostly normally concerned with is Spanish, but there could be other languages and other communities that would be, missed without the language, capability. And we also strongly recommend keeping track of it. So you may have Spanish-speaking loan officers you didn't hire to be a Spanish-speaking loan officer. You just hired a loan officer who's good. But you might want to, maintain, visibility into, what languages your loan officers speak. The other thing is the government very much looks for you to be doing some sort of affirmative hiring. And if you're not able to make loans, if you're having trouble making loans in some of the minority neighborhoods, well, they'd say, well, why don't you try hiring LOs who, in essence, look like the populations in those communities that you aren't successful in serving. That's what you'll hear from the government. It's obviously a lot harder to do in real life than it is for a government lawyer in Washington to indicate to someone they ought to do it. But that's kind of what we hear from the government and what we also see in consent orders when they are negotiated.
The one thing I've just add, Jeff, on this slide is that even if you're not successful in hiring the, Spanish-speaking LOs or whatever language it is worth documenting the efforts, because even if you're not successful, I think when the government comes in and says you aren't serving this part of the MSA, you say, look, like, we are aware of this, and we, here's all the stuff that we have done. And even if it's unsuccessful, it does just, I think, go a long way towards undermining a case that you're intentionally not making loans in that part of the city.
Can we flip slides? So the next issue is, what's your product set? And we see this being a significant issue. I think probably many of the people on the phone know that, majority of minority customers end up being served with FHA loans. There are lenders who don't do FHA or do very little FHA. There are lenders who are like new lenders, especially, who don't have all the FHA approvals they need to, make FHA loans. So, what do you do? It's like, well, one of the very successful techniques a client used in order to improve its lending performance in minority neighborhoods was to expand its product set. Now, this client was a bank, and they were able to do some portfolio loans. So they created some special kinds of portfolio loans, not saleable into the secondary market. They were able to, really improve the relationships they had with local realtors and developers and builders who wanted to be able to sell the homes that they were creating. Bond loans, expanded criteria GSE loans, even special purpose credit programs. We've helped a lot of clients develop special purpose credit programs in the last year. It's become a very popular structure for people to look at, where you are even more specifically targeting, kind of traditionally underserved groups. But the product set is what is going to make you a more successful if you have a wholesale, business structure. Brokers who do business in those communities are going to be more interested in having a relationship with you. And if you're retail, kind of the realtors and other referral sources are going to be much more interested in working with you if you have a product set that's going to hit a higher percentage of their, of their customer base. Okay, let's flip slide. marketing efforts. And this is actually one of the, I started all of these bullet points with could you show? And that goes to the fact that there's a million things that happen at your company that you couldn't prove later. And, being able to prove these things later is oftentimes what you need to do with the government if you're kind of starting off with at a disadvantage because your statistics weren't that good. So if your statistics aren't that good, and you say, well, we're trying, we aren't redlining because we are actively trying. Could you show it? Could you show the outreach that is being done to the minority, to realtors and other kind of referral sources in the minority neighborhoods? Could you show that you tried to reach to those brokers? Can you show the advertising aimed in those areas? That's the kind of thing that you need to be able to show the government. And we're used to it being in the context of okay, we're behind the 8 ball. We haven't been, our efforts haven't been successful, but convincing the government that the unsuccessful statistics are not, indicative of a effort not to lend in particular areas. John, do you have anything to add on that?
No, I mean, I think this is the same point we made earlier about, demonstrating your efforts to hire LOs in these neighborhoods. And it's just, at the end of the day, right, the ruler that we're all measuring the back and forth upon is what would happen in litigation. And if you have evidence that is going to be compelling that you haven't engaged in any discriminatory conduct, the agencies will eventually take that into account.
So let's flip slides. The next thing is, and it's a little bit silly, right? Has anyone in your company or any of your referral sources ever sent you, an inappropriate joke, used a inappropriate phrase? We know that, because this happens in the litigation, right? The government and the investigations, the government says, we want to look at all the emails of everyone who was involved in your loan origination function, right? Or something like that. And there will be innumerable inappropriate emails sent in your company, inappropriate texts, that sort of thing. But this is really important. These are really important pieces for the government's case because they're trying to show that a statistical finding that a jury or a court should infer discrimination from a statistical finding. And the way they corroborate it is to show that your company was filled with people who have racial or other animus in them. And what better way than to use people's words? Now, most of the things that we see are not people who are necessarily have racial animus, but they're passing along a joke that they thought was funny, or that doesn't look so funny when the lawyers look at it 2 years later. So it's that kind of thing. So what that goes, in essence, goes to, you need to have different mechanisms for training people not to put certain things in, not to say those sorts of things, not to say them in writing. If they get a really awful meme or joke from someone, maybe they should send them back an email. Hey, you really shouldn't send things like that to me, right? Because like a lot of times, especially for people in sales roles, they're in contact with people who send them things that aren't so great to have when you're defending an anti-discrimination claim. John, anything on that?
No, I mean, I think this is just, it's a gift to the government, right? Because it's forced with both the press and the jury far outweighs what it actually should be, used for, and in terms of inferring an explanation for whatever the lending patterns are. to Jeff's point, but it's absolutely devastating to the defense of the case, because if nothing else, it makes it really hard to defeat a summary judgment motion when you have stuff like this.
Exactly. So let's flip the next slide. Training. So training is really important. So if you want to show that you've done good training for your folks, particularly the ones that are on the front lines working to attract loans. Almost everyone we know does the computer training. There's like, they can buy a computer module fair lending training and they do that, which is helpful. But the more you can show the government that actually you were trying very hard to encourage your people to comply with these laws, the better off I think you'll be. Can we flip to the next slide? So we'll just talk for a minute on the mortgage comparison platforms, and we'll flip to the next slide after that. So John, do you mind jumping through these, or do you want me to?
Happy to do it. So we thought it would be, this is sort of a recent development that we thought you all might be interested in. I think it was 2 weeks ago, the CFPB put out an advisory opinion, and I'll just, a slight digression on the CFPB's use of advisory opinions. When that program was created, the intent was to allow industry to go to the CFPB and say, hey, we're not sure how to comply with RESPA or EFTA or some of these other statutes that have safe harbors in them for compliance with an opinion of the agency. Tell us, what is acceptable conduct, and make it public, and then everybody in the industry can rely upon it, if there's private litigation. And that worked well enough for a little while, and then when the new director came in, they've been using the advisory opinions much more as a sword and less as to provide defenses to private liability. And so this is just another example of that. I mean, it was primarily directed at the operators of mortgage comparison platforms. And I think the bottom line basically for those operators is, look, you need to be presenting consumers with options about mortgage loans in a way that is completely neutral and understandable to the consumer. So, for example, they say, I want to see what the lowest rate is for someone with my characteristics, or what is available at this loan size, or what have you. And if you're not presenting all the lenders in that sort of neutral, as the Bureau put it, neutral fashion, the Bureau will infer that that is a referral, because what in effect you're doing is suggesting like this lender who may not have the lowest rate is at the top of your list, and therefore you should take a loan with them. And so that's a referral. And sort of other part of the coin in terms of Section 8 liability is, is there an agreement or understanding that you're getting compensated for that referral? And the Bureau's basic position here is a mortgage comparison site can be paid for the service of allowing lenders to have their products viewed by consumers, but that's about it. And if there's differential payment, the Bureau is going to assume that that differential payment relates to a referral, because why would there be differential payment except for the fact that you're promoting this lender in some way? And so this takes a lot of different forms, right? Non-neutrality. I mean, the Bureau pointed out some sites will have sort of top shelf lenders, even if it's well disclosed that, look, these lenders over here, as you'll see in like a Google results screenshot, even if you're fully disclosing it, the Bureau says that's not enough. It's still a Section 8 violation, because you can't disclose your way around a referral. And, you know, sort of associated conduct like, you know, immediately transferring a lead to a particular lender, that you are getting compensated for that could be a compensated referral. Sending follow-up text messages to borrowers, you know, could be conduct that is, you know, you're compensated for in the Bureau's mind, a compensated referral. Jeff, you had raised the affiliated business arrangement issue. I don't know if you wanted to talk about that.
Yeah, no, I mean, one of the things is that, you know, obviously an affiliated business arrangement is a type of referral where there's Congress created an exception saying, well, if you give this kind of disclosure and it's in the CFPB reg now, right? And you only get paid by virtue of the, you know, in essence, dividends up to a common parent. If that's all there is, then that's fine under RESPA Section 8. And that's been part of the statute for a long time. And the Bureau is kind of like, well, because they don't like even to have a disclosed referral, they're saying, well, it might be if it's not, if they're, because they have such an expansive understanding of what might constitute, what kind of, you know, dark patterns of, you know, on the website might constitute also, you know, a kind of a hidden referral in essence, that, you know, I guess, which is kind of a funny thought, that it might be a UDAP, because even if you give a refer, you know, kind of a disclosure, they don't like the idea. So, but they're worried that they might not be able to bring a RESPA claim per se. So they kind of warn in the guidance that, well, even if we can't bring a RESPA claim for whatever reason, we might very well bring a deception claim, a UDAP claim. So it's kind of an interesting, you know, way that they're trying to undercut the statutory exception. I think it would be really fun if someone had that kind of issue. John and I would really love to go to toe the Bureau on it, though it might not be much fun for the company. But it's kind of an interesting perspective that they kind of put forward in the advisory opinion. And I do wonder if how hard they would try to push on that particular position, or if they're just trying to, you know, kind of, you know, bully pulpit their way to get people to be afraid to set their mechanisms up in a way that they're uncomfortable with, which they're uncomfortable.
I mean, in a slightly different context, I can attest that the Bureau is pushing UDAP theories that are sort of clearly outside of the lines of a clear carve out in one of the enumerated consumer laws that was enacted in the 1970s. And, you know, that's a frequent thing that they do with UDAP authority, which is intensely frustrating because there are clear lines and companies will abide by them, but then UDAP is so amorphous that that it comes in to erase the lines that Congress drew. So I'd be careful, even if it's okay under RESPA. And then the final,
go ahead.
The final thing on this slide, and it's probably too obvious to say, but you know, RESPA violations always have two potentially liable parties. There's the person who received the thing of value and the person who paid the thing of value. So obviously, you know, I think the focus of the advisory opinion was on the operators of these platforms, but the lenders are also parties to the arrangement and so would have the same liability.
Great, let's flip to the next slide. So we'll just talk for a minute about Silicon Valley Bank and Signature Bank. I mean, it's you know, it's been in the press a lot. We figured we ought to just say something about it. So we'll flip one more. And John found such a great image. I'm really impressed from It's a Wonderful Life. But, you know, I think, you know, we saw this, you know, maturity mismatch between, you know, short-term deposits and long-term securities. obviously the whole portfolio of securities and loans at many banks are underwater because, you know, they were entered into at a time when interest rates were substantially lower. Inflation has taken off. So there's some weakness, some financial weakness kind of hiding in a lot of balance sheets. And then there also has been some concentration risk issues where, you know, like tech businesses, you know, a lot of these like VC funded tech businesses are not doing so great right now. And that's kind of where Silicon Valley Bank was most focused. So it's kind of a difficult financial situation. John?
Yeah, I mean, also, I think it was the case that SVB's asset, you know, mix was heavily dependent on deposits and heavily dependent on large deposits, you know, principally VC-backed tech companies that were their bread and butter. And so that, I think, also was a major contributor to their woes, because as the next bullet point gets into, all those folks are really part of a very intertwined network. And Jeff and I were listening to one tech CEO talk yesterday who said quite proudly that on Thursday morning he was able to run on SVB. And I think it's, you know, really interesting to see what you know, sort of what happened in the old-fashioned way that we saw happen in It's a Wonderful Life happen in this new sort of social media world where, you know, tweets from certain people or big text chains can really spark what looks like an old-fashioned bank run in our digital age.
Yeah, and it's interesting. In 2008, there was a big bank failure in California of IndyMac Bank, and at the time, some people blamed now majority leader Schumer for having made comments from, you know, with his position on, I can't remember if it was the banking or the finance committee, having made comments that IndyMac was in trouble, and that kind of started, that kind of helped to trigger a run on IndyMac that, you know, landed in its ultimate failure. Although I'm sure I'm missing a lot, innumerable pieces of the factual puzzle, but that's the kind of the allegation against Schumer. But what we saw on Twitter, right, in the last week has been a lot of, oh, this bank is failing, oh, this bank is failing, or everyone get their money out of this bank. And that's, you know, it's really hard to respond to those sorts of things as a bank or as a regulator. And it's also kind of a funny, Silicon Valley Bank, only about 10% of its deposits were insured. So they had about $175 billion of deposits. Only about 20 or $25 billion of that, or $15 billion of that was insured, meaning all the rest was above the $250,000 cap. That's really pretty extraordinary as a percentage. But happily, starting on Sunday, you know, Sunday mid-afternoon, kind of this late afternoon East Coast time, the responsible federal agencies said, we're gonna declare this a systemic risk. We're gonna use our systemic risk exception authority, and we're gonna expand the deposit insurance to everything. And they further expanded it to qualified financial contracts, which are, you know, in essence, derivatives, payments on derivative securities. So they're protecting an enormous number of the obligations that these two banks, SVB and Signature, had. And at the same time, the Fed created a new funding structure where they will lend money to banks, and in which they will value collateral that's kind of underwater because of interest rates. So high quality collateral, they're going to value it at 100 at par, which is a really nice thing to do. But it's a 1 year structure, and I guess we'll see over the next little bit whether whether these actions collectively really, succeed in calming the market down, or if we're going to have, it's going to turn into a further kind of concerns for all the banks other than the very biggest banks in the country. So that's really all we have to say. We're very happy to take questions on this or anything else.
Great. Well, thank you both. I didn't realize that SCB only had 10% secured deposits. That is shocking. Anyways, my 2 cents. So I understand we do have some questions.
We do.
Sam will read them off for you both.
Okay, so first one, if there's time, I'd love to hear your thoughts regarding the recent Park National Bank redlining settlement, including failing to serve LEP consumers.
Sure. Well, that's been an issue DOJ is very focused on. Park National seems like all of the other cases in most ways, in the sense of the proof against them was, well, your statistics aren't that good, and then you didn't make a lot of what I guess I would consider affirmative efforts to specifically seek to serve minority neighborhoods. They were also hurt by the fact that they had internal documents from compliance saying, hey, we have an issue, do something about this. We got to do something about this issue. And that didn't trigger action. At some banks, if, when compliance says, hey, we have a fair lending issue, the board will get hold of that pretty quickly and they'll start to take action. And here, at least according to the Department of Justice and their view of the facts, which may not be actually true, but their view was, look, you had warning from the compliance department and nothing happened. With respect to the LEP piece, the government has been, particularly during Democratic administrations, been extremely focused on the ability to reach out to people who don't speak English as a first language. And there have been a number of arguments made back to the government, including the fact that most of the, it's as a factual matter, most of the home buyers, if you're going to actually, the people in the Hispanic community who are going to be actual home buyers are mostly people who are sufficiently, in kind of mainstream American life that they speak English. That is not a successful argument, just so you know. In case you're hoping to make that argument, I can tell you it's not going to be a successful one. No, so they're looking for outreach, and it goes to the comment we had made earlier about trying to have, loan officers who speak other languages. We are seeing across our whole practice, we are seeing increasingly both banks and non-banks looking to do more and as much of the loan origination process in Spanish as they possibly can, without running into the problems that you run into in especially California and Texas around, if you negotiate a deal in Spanish, you have to complete the whole deal in Spanish, and that's, or in whatever language. And most places won't accept a Spanish language recorded document. So it's very hard. We don't really have the processes and documents and everything for most part to really complete a transaction in Spanish. But you can certainly, people can hire Spanish speaking or Chinese speaking or Vietnamese speaking, or whatever language it might be, loan officers. You can try to have a better way of being able to address them, and that we're going to see the government pick on an inability to do that as a failing if your numbers aren't that good to start with. John, do you have a different view?
No, I share your view, but I just want to make the additional point that we've been talking about the origination side, and the government is also very focused on serving LEP customers on the servicing side as well, and putting pressure on large servicers to make sure that that they're equipped to help those folks in loss mitigation or other aspects of the servicing relationship.
We just had one last comment. It was, I think another key way to refute the government statistical analysis is to show them the analysis you've performed. The HMDA data set is broad, but not comprehensive, and lenders have more data than they do. To the extent that the additional data shows is legitimate credit basis for the reasons for variation, it helps prove out the lender's story and overcome the government's story. An additional add-on.
Great point.
It's largely true. And the other piece here is that so much of this in redlining is about applications, not originations. So it's like the credit-based stuff a lot of times is really about, hey, our denial rates are higher, but we made all of our decisions correctly based on the credit, based on the credit of the applicants. The applicants, though, they're saying, the allegation of the government here is you didn't try hard enough to get applications in to even then get to these, in essence, credit-oriented statistics. One other thing that we've worked on with clients is showing like, oh yeah, well, here's why that whole, that you showed us one of these maps, these dot maps like that John had mentioned earlier, showing these big swaths of a city that didn't have any loans in them. And they're saying, why didn't you make any loans in that area? And the answer is, guess what? Like that's this piece of property is uninvestable for this reason. They can show, in whole neighborhoods why it's really impossible to make a, normal residential mortgage loan. But that's a hard task, because the government starts off not wanting to believe it. So it's kind of there's a lot of work involved in pressing that, pushing that rock uphill.
Well, that was the last question or comment we had. Just other comments coming in saying great presentation. So thank you both for your time. Jarlath, anything else?
I actually have one question. Jeff, when you were speaking earlier, the term you used was statistically significant when looking at the HMDA data in comparison to peers. Is there an calculus for what is statistically significant, or is it just in the eye of the regulator?
John, do you want to take a crack at this?
I mean, there is an understood, this is why we hire economists to help us crunch the numbers, but I think there is an accepted meaning within, statistics of what is statistically significant. And I forget exactly, it's like,
okay.
99% confidence or 90% confidence that this is not random. What it boils down to in large measure is going to be the sample size and sort of the direction of the sample.
Okay, that makes sense. Well, thank you both very, very much. We appreciate you taking the time out of your busy schedules to give us your thoughts on these issues. Very, very well done. And of course, thank you, Sam, for being our organizer and running the show. Everyone, please keep an eye out for the next quarter webinar. We'll be sending out or scheduling that probably in the next 2 to 3-ish months. So keep an eye out for it, and we hope to see you all there. Thanks, gentlemen.
Thanks, everybody.
Thanks, Jeff and John. Have a good one, everyone.